What's going on, everybody? TG here, back with another video, and today we're going to be talking about the difference between a leap call and owning shares and which one is more beneficial for your account size and your strategy of investing. So let's just jump right in. Before we start though, hit that like and subscribe button. So obviously there's a difference in owning a leap call and 100 shares. It is very similar, but it also differs in many aspects. So let's use Amazon as an example because I have a leap call on that. As you guys can clearly see right here, this is an Amazon 3100 strike price, dated January 21st, 2022. Now, that essentially says, I believe that Amazon is going to be above 3100 by that date minus the option premium that I paid. So I paid $454.45 per share, giving the average break-even cost on this trade $3,554 a share. So I'm essentially betting that Amazon will be above that at that time. That's one way of looking at it. There's also another way of looking at it. If you want more leverage in a stock, for instance, Amazon, which if I wanted to buy 100 shares of it, would cost me $336,000. I can then get that leverage kind of with this leaps call. Okay. So let's go ahead and look at actually what this leap call entails. So first off, delta. This means basically essentially that every dollar that Amazon goes up, my option will go up 66 cents. So essentially right now I have leverage of about 66 shares of Amazon. Now, we pull out the calculator right now. We can actually add up how much this is actually worth. So we have 66 times, and then the price of Amazon, which is 3,363. So 3,363. That is essentially worth $221,000. Now, if we look up how much this leaps call is worth right now, it's worth $58,900. So we do that same thing, $58,930 divided by the price of Amazon, which is $3,363. I could only get 17 and a half shares. So I'm getting a lot more leverage on this position, but obviously risk entails. Let's say Amazon decides to crash. Well, every dollar it goes down, I'm losing a lot. That's one thing. Also, if Amazon is under 3,100 by this date, I lose all the money I put in. So all $45,000 that I put in is gone, absolutely gone. But I can also use this as leverage to sell covered calls on Amazon. Since this call is in the money, which means I can exercise it, I have leverage to sell covered calls on Amazon. So if I wanted to, I could go over here. I could go to sell call. And let's do next week because it's already Friday today, so nothing's going to be really going for much. If we want to sell this call, we could go here and sell a $3,500 call and get paid $1,025. So that is one of the benefits of having a leaps call, because obviously I cannot, sell covered calls on Amazon with only, $50,000. I would need $336,000 in order to do that. But this leaps call allows me to do that since it's in the money. Now, let's talk about the Greeks, because the Greeks and options are extremely critical, because that is, in a sense, how you end up making money on these options. So if we go back to that same option and we look at the Greeks, we went over delta. Every dollar that Amazon goes up, it's going to go up 66. Gamma is essentially every dollar that Amazon goes up, the delta is going to go up 0.003. So it's a very small gamma, but when you're talking about increments of, like 100, like the way Amazon moves sometimes, it can go up a lot more. And then theta. Theta is the biggest risk when buying options, because that is how much an option deteriorates every single day. So every single day on this option, I lose about $62 every single day. Okay, so you have to kind of be careful about that. So let's say Amazon sits exactly still for a year. Well, I'm going to lose everything because I'm going to continue to lose that theta every single day. So that's another risk when it comes to buying these leap calls. The advantages of buying shares and just holding shares straight up is you can hold them forever. You don't have to worry about a certain date. You don't have to worry about theta. You don't have to worry about anything. You can just simply hold your shares and be fine. But with this Leaps call, you obviously have to you have a time period. You have a set amount of time where the underlying asset, in this case Amazon, has to go up. So obviously, if Amazon is at the exact price it is right now on expiration date, well, I'm going to be losing out on some money. I'm not going to be losing out on everything because it's still above 3,100. But my break-even price is 3,554. So as long as it's above that by that date, I break even. But if it's under that, for every dollar it's down, I'm down $1 on the option. So you have to figure it out that way, and you have to take that into consideration. So the good news for me is I'm up 30% on this option. Now that's almost $14,000. Had I just bought in the shares, I would not be up nearly this much. Okay, so when you're very bullish on something, you want to buy the option of it because you're expecting a greater move, and then you can actually make more money off of that. But obviously, like I said, there's risk. When Amazon had its earnings the other day, and they were good earnings, but the stock still went down. Like right about here, it was doing really good on February 2nd. We had earnings, and bam, it dropped hard. My option lost 10% of its value in one day. So that's $5,000 gone, where the stock only moved down like 1%. So you have to be careful on that. You have to think about that. But like I said, you can use that to sell calls and make money as well, which is pretty awesome. So I'm actually going to be doing that pretty soon. If I see about 3,400, I'm going to go ahead and sell a call for next week because I do think it's going to actually start to run because earnings were so good. And I'll probably write one for like 3,550. Okay, like something around here, and try to get about $1,000 if it goes up there. Try to do that every single week, and that way that mitigates my theta because I'm making so much from the actual option itself. So it's kind of a hedge, which is pretty cool. So, I think in some scenarios, like expensive stocks like Amazon, if you have a smaller account, buy Leaps calls. I did that on Visa as well. I have a in the money Leaps call that I use to sell covered calls on as well. And we're up a little bit on that. We actually sold one of those today, but we're up, 30%, $670. Instead of spending $20,000 on it, I spend $2,300 on it, and I still get the equivalent of it. So it's pretty cool, and it's pretty interesting, and it's a great way to make some good money in the market. And you can use these, like I said, to hedge yourself if they're in the money, or you could go farther out of the money. It would cost you significantly less, but you'd end up making more if the price went up there. So there's a couple schools of thought of looking at it, but I personally like in the money. That way I can write covered calls and hedge myself and, make profits basically every single week that the stock goes up. So it's just one way of looking at it, and it's been working out pretty good for this past month. We're up about 29,000 for it. So it's just something to think of, something to do. And if you guys are interested in this strategy, definitely take advantage of it, especially if you have a smaller account. I definitely recommend this because not everyone can afford 100 shares of a company, especially great companies like Apple. It's a great way to have that leverage of those shares and not have to spend, $15,000, $30,000 on it. So let me know what you guys think about it. Remember to like and subscribe, and I'll see you guys in the next video. Goodbye.